Hey everybody, it's Aaron Norris with the Norris Group. It is the last Friday the 13th of the decade. And when it comes to the last decade, what are you going to remember? That much more as we cover the biggest headlines in real estate. Up on the radio show and podcast, Dad, Bruce, Norris, and I talk about Turmoil, the event we have coming up February 1st, looking at everything from market timing to strategies to legislation and regulation that might impact you on all the things that just passed in 2020, but also things that we're going to have to think about in the next election cycle. You won't want to miss that conversation on this week's radio show and podcast. The Mortgage Bankers Association reported mortgage applications increased 3.8% from last week. Overall delinquency rates for September were their lowest in 20 years at 3.8%. Home flipping activity decreased with 56,566 single-family homes and condos flipped in the third quarter, down 12.9% from the previous quarter and 6.8% year over year. And mortgage rates increased slightly this week with 30-year rates now at 3.73% and 15-year rates at 3.19%. Which state have the longest foreclosure timelines? Well, Adam data shows us in the third quarter of 2019, there were 143,000 foreclosure filings, down 6% from the previous quarter and 19% from last year. Just keeps getting lower. The top states with the longest foreclosure timeline include Indiana with a whopping 633 days, Hawaii 626, Nevada 1,511, New Jersey 1,173, and Pennsylvania at 1,170 days. Holy cow. Rent control advocates on Thursday submitted signatures to get the issue back on the ballot, tweaking the soundly defeated Proposition 10 from 2018 and hoping to return it to California voters next year during probably what's going to be a huge turnout and one of the most contentious election cycles ever. Supporters say the new proposals would strengthen rent control measures passed by the state legislature this year and also protect homeowners, and the measures are needed given the state's housing crisis. About 1/3 of state renters spend more than half of their paycheck on housing, according to the coalition, but opponents say the measure will hurt homeowners and reduce incentives to build new affordable housing. This extreme form of rent control would lead to a mass exodus from the rental housing market and exacerbate California's housing shortage, so says Tom Bannon, the CEO of the California Apartment Owners Association. And keep in mind, on the next ballot, we're sort of thinking Proposition 13 might come up, and apartment owners are going to be very engaged. The Southern California News Group released their housing permit report card, grading Southern California cities and counties on how well they are meeting their state-mandated goals to issue housing permits, also known as Regional Housing Needs Assessment, or RHNA. Jurisdictions are required to plan for adequate housing across all income affordability levels, but very few of these cities and counties are actually meeting their goals. And we've covered this several times with the state and Senator Wachowski, one of the reasons ADUs have become so popular. The scoring system is interesting as it gives points for cities by category of housing, including low income, very low income, moderate, and above moderate housing that they're building within the jurisdictions. It even applies bonus points if cities and counties are doing better in the lower income levels. So how are we doing? Only a few cities in Southern California got an A+, which includes San Bernardino County, Santa Ana, Westminster, and surprisingly Beverly Hills. But looking into the numbers and rolling over the map, which is very cool by the way, you're going to notice that Beverly Hills only had to permit 3 homes, 3, between 2013 and 2021 in those categories. Yes, I get it, they're a smaller footprint. Yes, they're landlocked. However, when I look at my hometown Riverside, they got a D-, but they are supposed to build 8,200 in that same time period. I'm not quite understanding how the RHNA numbers work. I will get down to it in 2020 and figure it out. And I think there actually has been talk about them redoing this process, but we'll see. Cities with Fs, only partly because there was quite a few that didn't do very well, but Huntington Beach, Torrance, Laguna Beach, Redlands, Coltland, and Moreno Valley, and Upland, just to name a few. Zillow says renters spent $4.5 trillion on housing this decade, almost 50% more than last decade. This is more than the GDP of Germany or the combined market values of Apple, Microsoft, Amazon, and Alphabet together. Just this year alone, renters spent over $512 billion. That's 46.5 more than 2009. Rent prices continually increased since 2012, and the current median rent being $1,600 a month, up 2.3% just from last year alone. MarketWatch says that the rise in iBuying is gaining steam and could cast a cloud over America's property market. The argument is that it could make certain real estate economic indicators less reliable, clouding the picture of the housing market's health. I've been having this conversation with Adam Data and CoreLogic, and I've let them both know because some properties, depending on if a wholesaler sells it to an iBuyer and the iBuyer sells it to a consumer, that transaction has a potential to show up 3 times within short order, and a lot of the algorithm that they use to monitor flips, that's going to be caught multiple times. It's going to mess everybody up. They're going to have to bifurcate that data and the traffic to get it right. Hopefully they'll fix this. But it reduces the accuracy and usefulness of the data, according to Joshua Shapiro, and I would agree. The National Association of Realtors periodically benchmarks its pending and actual sales data to attempt to account for this and other factors that can affect the accuracy of the data, but it is unlikely that even this benchmark process can fully deal with the effects of such market changes. Since a lot of different real estate divisions are launching iBuyer program, this is going to be more of an issue. So you've got Realogy in the mix, Keller Williams. Everyone's talking about iBuying, so we really are going to have to focus on this in 2020. And I think 2020 is going to be a very exciting year for the iBuyer market. If we hit a little bit of a recession, will it stick or stay? I don't know. We'll have to wait and see. We're about to step into a whole new decade. What we call this upcoming decade the roaring 2020s. Well, Realtor.com this week took a step back to remind us what the last 10 years look like for real estate. We will give you the list, and you can decide if it's what sticks in your brain as far as the high and lows for real estate. Here's what the last decade brought us according to Realtor.com. We've got a foreclosure sweeping the nation, the building bonanza that dried up, America's first real estate president making home ownership actually tougher because of some tax changes, natural disasters impacting several real estate markets, everything from fires to massive hurricanes, the resurgence of the downtown and the sleepy suburbs, tech effects and Amazon's hunt for headquarters 2, the HD TV world making all of us think that we need to live in something way fancier than we can afford. One thing that wasn't on their list was iBuying, interestingly enough. Maybe that'll make next year's list. Another thing I think is that they shouldn't have left out is the reification of single-family homes. A lot of Wall Street money backing into the real estate market, buying and putting together massive rental portfolios. But I want to know what you have to say. When you think about the last decade, what stands out in your mind specifically when it comes to real estate, either from the investor, property manager, or realtor side, mortgage side? I'd love to hear about it. If you're on YouTube, please leave your comments below the video, and don't forget to like and subscribe to the channel. Hit that bell if you'd like to receive notifications when we have new videos come online. If you're on Facebook or any other social media platform, please like and make sure to like the Norris Group page so you can find our content online whenever we produce it. Leave your comments below the video, give us some love, and don't forget to share. If we missed a story, also feel free to leave a link in the description below. We are finished speaking for this year, but we have a very busy season coming up in January of 2020. We've launched an all-new chat, 6 things you'll need to succeed in 2020, and the first date we're doing that is January 7th at Prosperity Through Real Estate in LA. That very next day, we're doing that same talk at the Los Angeles Real Estate Summit with Robert Hall and Associates in Glendale. January 9th, we'll be in Orange County at OC RIA. January 14th at Coachella Valley Real Estate Investors Association. So all over Southern California within about a week's time. February 1st, Turmoil, the Coming Storm of Change. You're going to want to check out our radio show and podcast to find out a little bit more of what we're coming up with. It's our first hybrid event, and we'd love your support. We think it's going to be super nerdy and really help you out next year. If you're thinking about investing out of state, you are going to want to check out our March 19th and 20th Florida Property Buying Boot Camp. Maybe you're looking to 1031 exchange some of your rental portfolio into another location, into newer and nicer inventory with better tenants, or maybe you just want to take a deep dive on what you should be thinking about when you're going into another state. You will love the deep dive that we do and the one-on-one attention you get with Bruce. So check that out on our website. All of our events are located under the training tab. For more information on hard money loans, including fix and flip, buy and hold, and new construction, check out that hard money tab. And for passive investing with trust deeds, notes, and mortgages, check out the invest tab. With that, have a fantastic weekend, and we'll see you next week.